Well, thank you for joining this panel. We're going to cover the ETF landscape, maybe cover some history, where it's headed. It's certainly one of the most interesting markets in terms of finance. On the investment management side, it feels like a lot of the innovations and certainly a lot of the headlines originate off the ETF landscape, both here and abroad. And there's always a topic du jour. And so it's been a fascinating journey for myself. And I love this chance now to sort of introduce everyone else to our panelists, starting with Dave. And then we'll just go down the line and give them about a minute to talk about who they are. And then we're going to go dive into our first topic.
Let's see if I can do it in under a minute.
All right.
My name is Dave Nadig. I have the interesting title of Financial Futurist at VettaFi. What that really means is I spend most of my time trying to explain asset management to financial advisors and trying to explain financial advisors to asset managers. Often the ETFs have been in the mix there. I've been in the ETF industry since about 1993. And have stayed in the ETF industry largely because, as Paul said, everything interesting seems to end up in the exchange-traded product wrapper eventually. And I think that has only accelerated in the last couple of years. So I don't think ETFs may be the thing that lasts for the next 100 years, but certainly going to be the rest of my career.
Athanasios, Psarofagis, nice to meet everybody. I work at Bloomberg Intelligence. I know Bloomberg's a big company, but there is a team there that does research on ETFs. Specifically, if anyone knows my colleague Eric Balchunas, I work on his team, cover all facets of the industry, building out content on the terminal tools. I was pretty lucky. I didn't have the foresight when I first started in this that ETFs would grow as much as they did, but I started off at a small ETF model provider, researching ETFs. Worked a couple of years at NASDAQ on their indexing team, Index IQ, and now I've been here about 5 years. We're also covering the European market, so I have a little bit of a global outlook as well. Obviously very different over there. But yeah, it's been a great industry to cover. Just when I thought growth was maybe plateauing, last year I think completely blew us away with everything. But yeah, nice to meet everyone. Thanks for having me too.
Hi everyone, my name is Kahn. I'm with Wolverine Trading. We are a trading firm based in Chicago. Making markets in options and ETFs. So I co-manage the ETF desk, the trading desk, where we are market makers or liquidity providers for ETFs. So we seed ETFs. We are the lead market maker or LMM on many ETFs. And we view ourselves as partners with many issuers. So Simplify is one of our partners. We LMM many of their products, help them through launch. Our goal is we try to be in sync with their goal, which is to create AUM, which means to make tight markets. So we hedge everything. We also have a sister company, WEX, Wolverine Execution Services, which does execution for many issuers, other institutions, hedge funds, et cetera. And we work closely with them to basically help within the ecosystem, again, providing liquidity for ETFs.
Great. Why don't we start with sort of where we are today? There's been some, when I think about the ETF evolution over time, the history started off as institutional beta tools and has slowly migrated to become your go-to beta for a number of asset classes, often the first beta exposure to many asset classes, and then increasingly went to much more nichier or factor-based or, just slightly more actively constructed exposures to then actively managed strategies to where we are today, where it feels like just about any investment strategy in any other vehicle, including hedge funds, can now find their way into the ETF wrapper. And the ETF wrapper to me is just a way to access exposures, whether it's, again, strategies or betas. And it's interesting on how fast it's grown, how dominant it's become in sort of at least entire generations of investors, right? It's sort of your go-to exposure, like the old iPhone tagline. There's an app for that. There's an ETF for that, literally. So why don't we start there, David? What's working this year? Certainly returns are challenged across most asset classes. where are investors putting their money this year?
Well, I mean, if you just look at the flows, it's pretty obvious. Like, folks have been moving towards safety. I think SHY was the biggest asset gathering ETF last month, the short-term bond fund. Things like lots of actively managed short duration type products too, like Mint for PIMCO, things like that. That's a pretty natural thing. Every time we get a market pullback, what we tend to see is folks sell their underperforming, overpriced, actively managed mutual funds. They park that cash for some period of time. What's unique this time is most of that parking is also happening in ETFs. When we saw this in 2010, 08, and 01, with the sort of last times we had major hiccups, most of that money sort of disappeared off the balance sheet, and we were like, well, it's basically in Schwab sweep account. That's where it's all sitting. Now that money is actually finding a home in other ETFs. So I think it's also worth pointing out that despite the fact we're in some pretty miserable markets, we're still like almost near record inflows into ETFs. ETFs are net buyers of equities almost throughout this entire downturn, which begs the question, where's that money, where's the selling coming from? And lo and behold, you look at the Morningstar data, it tends to be underperforming, overpriced, actively managed mutual funds.
What are you seeing from the Bloomberg?
My microphone wasn't working, so I got to hold
you
this up. I think low was the theme this year. What I mean by that, low cost, low duration, low vol. That seems to be where all the flows have been going. But what I find really interesting, to one point what Dave said, is the flows are still coming in. We were sort of spoiled last couple of years with the market being good, took in over $1 trillion in the industry in 2021. We're still really strong this year. But the thing that really impressed me was the number of products that are still coming out. We're at over 3,000 ETFs. I actually just looked at this stat recently. A third of the industry launched from 2020 on of the products. So if you think about it, they're all relatively pretty new products. So if you look at other sell-offs we had 2008 or 2018, we didn't have these many choices, right? All this product innovation that we have now. So there's a lot of places you can look for things that are working, right? And there's always something that seems to be working. PFIX, I'll make the simplified plug. That's been one of the big product successes this year. Managed futures, kind of the quote-unquote boring stuff. But the thing is, what's so interesting about this industry is there's so many products to cover. Just when I thought that, we sort of got everything covered, something new is coming out. So I think this is going to be an interesting thing to look at as there's future sell-offs and there's more and more products and more optionality for investors.
And then Ethan and firms like Wolverine are really the sort of gatekeepers, if you will, to product innovation, oftentimes because the front line of an ETF is the ability to trade, right? It's exchange traded, so it has to be able to list. And so Ethan, I'm sure, gets propositioned for dozens of ETFs in a regular week. And there are providers like ourselves who are always knocking their doors, asking for seed money and the ability to launch. So Ethan, how do you handle that sort of massive supply of ETFs that are trying to get LMM relationships signed up? How do you prioritize? How do you figure out which ETF is worth taking that risk and taking on the responsibility?
Sure. It's I have a long answer for that, but I'll try and keep it short. So first, to just pick up on what you were just talking about, more of the themes. We're seeing a lot of, and you mentioned the optionality, a lot of ETFs with options embedded in them. Simplify is a big user of options, which is one of the reasons we're attracted to them. So from our case, and a lot of market makers out there, I mean, there's many, but there's a few very large ones, and I'd say everyone kind of has their specialties. There are people who their desks just kind of gravitate to whether it's the fixed income area or domestic equity or futures. Our bread and butter is really options as a firm. So ETFs with options, in addition to regular U.S. domestic, is kind of where we've gravitated to. So one of the themes that we've seen in a strong way in the last few years, where most assets have been growing, has been these structured product ETFs or ETFs that have optionality in them to either capture the convexity, like Simplify does, or for downside protection. And They've obviously outperformed this year, especially the ones with the downside protection or floors, so to speak, like the ones that actually have the entire ETF is just a basket of options, which basically makes up the structured product, where you're capped on the upside, but you're floored on the downside. And it's difficult for market makers to provide that liquidity because in general, we're very short-term in nature in terms of our holdings because we're providing the liquidity. So one day we could be short 50,000 shares, 100,000 shares we create. Now we're flat. Next day we're getting long a couple thousand shares building up to a redemption unit. Our hedging isn't going to be with the options because to cross that bid offer on the options every day would just be very costly. So we need to come up with proxies for what the ETF is holding. And that's the challenge for the market makers as the industry is innovating and coming up with either less liquid holdings or more complicated holdings, such as options, which need to constantly be re-hedged and hedged, or VIX products, for instance, that many of them are embedded in ETFs. So a firm like ours, as we're approached by the issuer, we try to provide some advice in terms of what we think would be easier to make markets, and the goal there is to make tight markets because no one wants to list a product that's 20 cents wide or 30 cents wide on the bid offer. So we have to come up with proxies that work, and that's the feedback that we try to provide.
Ethan, if you don't, I just am curious. You're talking about sort of the imperfect hedge problem, right? Everything has a cost. You may not want to spend that much money to do that kind of perfect hedging. Talk to me a little bit about how that changes the risk of your business, because obviously if you've got imperfect hedges, you can do all the math you want until the market decides the math is different today.
Exactly.
And your almost hedge could all of a sudden be not quite a hedge.
Exactly. So that's the challenge, right? So coming up with those proxies or those hedges that work, being very active in the marketplace to keep our positions small. So where it gets difficult is if the product is illiquid. When I say the product, meaning the actual ETF. If there's not a lot of intraday trading, if the average daily volume, the ADV is small, that proxy becomes more toxic, right? Because you're going to be holding on to that longer against and not being able to create or redeem as often. And usually those even if it's a better hedge, we still have to make a wider market to take into account that risk.
Got it.
Once the product starts to trade a lot, and once the ADV of the actual ETF starts to move, we're more comfortable holding that proxy, and we'll make a tighter market. So they kind of go hand in hand, and it's a lot of innovation and trial and error.
Great. And on that, I remember David Burns and myself were sitting about a week to go before launch and of our first 3 ETFs. And we were just struggling to get a market maker to finally say yes. And why? We had options, right? If you have options inside of a ETF, it's very complicated. And just getting someone to take a shot on a firm with, I think I had some credibility and we had some reasonable prospects, but it took multiple no's before Wolverine and Ethan finally said yes. And so it's not an understatement to say they could literally make or break an ETF platform, and certainly at the ETF level, but at the brand level as well. And so there's a lot of business sort of decisions and risk management and a lot of technology that goes into it. And there's an entire sort of you could go down a rabbit hole on sort of product development and everything around that part. But I think it does impact and influence certainly the way we design products. We almost prototype it alongside the market maker. So that's not to be understated, that they have a very, very immense role. And the fact that they had to go, again, from making markets of an S&P 500 type portfolio that's relatively static to something where there's essentially intraday trading in actively managed strategies, to things that have non-linear payoffs, futures, and all sorts of things. It's really fascinating and interesting to see that as well. What about on the tech? Let's keep pulling on that technology thread. So Bloomberg is also in the background, not just a data provider, but is actually a lot of the plumbing in ETFs. Any developments on the ETF side that you want to speak to?
So for sure. So I can't speak too much on that end, but obviously we have a lot of functionality on the terminal, not just on the research side, but on the primary market side, right? And I think one real big catalyst of this was post the SEC rule. So a lot of people aren't familiar with it. The SEC rule passed, made ETFs a little bit easier to launch, but where I think one important aspect was this ability to use custom baskets, right? And that's definitely benefited Bloomberg because we do have a custom basket function on the terminal. So now they sort of, in the olden days, it used to be only a couple firms had access to this capability. Now they sort of opened it up for everyone else. And I think this feeds in nicely to the product innovation that we've seen, right? The option strategies, more fixed income ETFs that have been launched. So it's definitely, it benefits the entire ecosystem. And the other aspect, I should have mentioned that a little earlier, but we were talking about how, maybe the flows have been a little bit lower this year, but trading is way up, right? We still have 2.5 months. We've already exceeded every trading metric that we had compared to prior years. So not just, they're being traded quite a bit, and it's actually fitting. We're at the NYSE, right? So on average, it's anywhere 35-40% of all the trading is through an ETF. So that obviously, a lot of the trading is done through whether an RFQ platform or through the terminal. So obviously, as the ecosystem grows, and we also have a fixed income indexing business, which maybe has it's been great for a long time, but obviously has been hit a little bit. But Bloomberg is tied in pretty nicely to the entire ecosystem, so we benefit from its growth as well.
I think he's underselling the importance of how the fixed income market in particular has changed because Bloomberg's multiple interactions with that market. I mean, we've absolutely moved to a space where the new bond desk is actually the new portfolio manager of an ETF desk, right? That's where the inventory is. If you want a Citibank bond that, it's got this maturity and this specific, version of it, you're not calling a dealer anymore. You're going through like BSKT 2.0 and seeing who's got it in inventory and then hoping you can do a redemption to get that out of the fund. Like that's a bizarre shift in how bonds trade. Yeah. And we're just we're just in the beginnings of having a live rates market for the first time in decades. I don't think we really even understand how a lot of this is going to work in a year or two when fixed income trading has become much more mainstream and people really have opinions about bonds.
Well, you're seeing new issuers like bond blocks and others coming in. So certainly the ETF market is providing new use cases and different use cases, but those use cases then draw in new providers and new ETFs. So this has a very reflexive character to it, and that's what makes it so fascinating. Again, from an ETF provider perspective, every day there's some new product launch, new idea that's getting truly first tested in this part of the market, right, before anywhere else. That's fun. Ethan, what are some of the...
and I was just going to add, Dave, to your question earlier, for the market makers in the fixed income space, as these portfolios are getting a little more, holding bonds that are a little more difficult to get, again, the same sort of proxy challenge, right? And there's just so many of them out there, and that liquidity is become an issue. But as you said, like it has become a marketplace unto itself, just creating and redeeming within the ETF space on fixed income to get hold of those physical bonds.
And there are use cases that aren't so well known, but things like sec lending. As an institutional investor, right, you have additional returns available, whether it's option writing, sec lending, other things that make an ETF really interesting, even in the context of separately managed accounts, hedge funds, and other things like that. So I think as some of those get pushed downstream, as more of the access to these sort of incremental return streams become democratized, there's more opportunity there. Certainly, we're looking at things like selling volatility and generating income using options. Again, stuff that was very, very challenging for an individual to access systematically, and there's going to be more of that kind of opportunity set. What are some of the scary headlines that you're addressing these days, Dave?
Yeah, I mean, so the structural risks, I mean, everybody always wants to know whether or not ETFs represent a systemic risk to the markets, right? And I think we'll keep asking that question for at least another 40 years. So we're never going to answer it. I think, you're talking about things like liquidity mismatch between fixed income underlyings and how the bond ETF might be trading. Those things, they don't represent a risk in the sense that the entire capital structure collapses down. But I do think we're going to continue to see, wide premiums and discounts, particularly in things like junk bonds. I think when we start looking at the more complex option strategies, some of the ones that you folks are running, and you look at the volumes that we're seeing in individual options trading, that doesn't seem to have come down nearly as much as folks thought it would when Robinhood sort of had their day in the sun. Those things, I think, are where we should be paying attention, because I think a lot of folks get into more complex products and don't really understand what's going on in those underlying markets. And so when they see something, I'll pick on junk bonds, when they see something like an HYG or a J&K, quote unquote, disconnect from fair value because the underlying market hasn't traded in 3 days, they blame the ETF, when actually what's happened is, well, the ETF became the entire bond market, and now you just can't get a decent bid on this particular bond anymore. So you create this arbitrary and artificial appearance of a disconnect. I've been saying that for a long time, and people don't like to hear that, well, the ETF became price discovery. But at some point, you have to recognize if that's where all the volume is, ETFs become price discovery.
Yeah, I mean, we got an example of that on Monday, right?
Yeah.
The bond markets close, but the ETFs trade, and they're trading alongside global rates.
Right,
They move.
exactly.
So it's interesting.
Yeah, one of the things that I think is becoming an issue is, as we know, one of the big features of an ETF is the ability to manage taxes, right? And versus a mutual fund. And in straight up U.S. domestic or very liquid products, fairly simple to do, because the stated NAV, the net asset value that makes up the price of the ETF that you're actually redeeming, is very close to the basket. So you feel, as a market maker, you feel very comfortable doing that redemption at NAV. When the assets become less liquid and the pricing isn't exactly perfect, meaning the NAV is a little bit off from day to day, because, for instance, on options, listed options use the midpoint of the bid offer for the stated NAV. That doesn't mean that's what the value of the option actually is. So it's very possible to do a redemption and the actual basket you're receiving is different than the price of the ETF NAV, if that makes sense. So that's just on options. Now take it a step further when you have more liquid, certain swaps or other commodities that are being, or other assets that are being priced higher than what they're actually worth. Just for, I'm trying to think of some examples, but on the option side, it's becoming a challenge, because a lot of the issuers we work with want to do that, those custom redemption trades to manage those taxes. And we are slowly finding ways to do that. It's been a challenge, but there are ways to get there. And I think that's going to be a big, once the industry gets better at that, let me say, I think you're going to see more actively managed strategies come on board, even more ETFs with options, because that's, I think, what's kind of holding it back. So that's I think, probably going to be either some rule changes or some more innovative ways of doing those trades is going to make a big difference.
What are you scared about?
Well, so I did notice, I don't have to mention any other media outlets or anything, but there used to be a whole slew of, worry articles on bond ETFs. Right. I've noticed after March 20, after the COVID sell-off, those have sort of stopped. Well, so we've done a lot of research on the side, and is the ETF maybe the ideal vehicle for every single thing? No. But what I always find is lacking in these arguments is they never mention, let's say, a mutual fund, right, compared to the ETF. It's always like, oh, the ETF did this, ETF's trading at a discount. I understand transparency is a two-way street, right? And so when we maybe thought things looked really bad in March 20, well, were they really that bad, right? It's just, this is what, and your thing about if the ETF sucks up all the liquidity. I've heard a term called like vampiring, which I think is something we should keep an eye on. Like, let's say if the ETF sucks up all the liquidity and everything's just being traded on the liquidity or on the ETF, how does that actually impact the underlying? But one thing I am keeping an eye on is, as ETF launches are getting on, let's call it the fringe, single stock ETFs now, levered single stock ETFs, et cetera. Those are on my radar. I just hope I don't see a headline that, the Tesla 2X1, maybe has an issue like, accelerated redemption, or it goes beyond a certain volatility metric for the day. So that's definitely stuff that I'm keeping an eye on. I'm not saying it's worrisome, but it's definitely, as the fringes get pushed out, I think it's important to keep an eye on.
I'll take the worry heat on that. I worry everything you just mentioned for the most part relies on swap counterparties, right? That's a lot of the innovation we're seeing in the ETF industry takes the exposure you want, offloads the management of it to a single swap counterparty who's now on the hook to do whatever. And we saw this today. One of the cannabis ETFs went down to 6 holdings, and the way they got away with that was instead of owning the stocks, they just own the swaps. And that's a bit of a dodge because the IRS just looks at you as owning cash, right? So it's kind of a hack on the ecosystem. But all the interesting stuff that I've seen in the hopper, the single stock stuff, the fake ADRs, some of these sort of micro products that have just a handful of holdings, most of them are based on swap counterparties, which is not a well understood market. They don't even list the counterparties. You sort of assume that they're credible. But it's not like buying an ETN where it's like, oh, Credit Suisse is there. I know exactly what CDS to buy to make sure I have no counterparty risk. Yeah, they're all daily settled. Yeah. There's a lot of over-collateralization. I'm not super panicked it takes down the market. But with so many swaps-based products potentially coming out, particularly with the single stock stuff, I worry a little bit about that. There are only a handful of folks out there that do those swaps.
Yeah, I agree. And actually, I don't want to become the some worry guy, but it's happened in Europe before, right? There was a couple 3X oil products that were swap based, and the swap counterparty pulled out, and that's it. The product's done. So, hopefully, we've learned from that, but it's definitely something that we have to honestly keep an eye on, because I don't want to just also be an industry that's always just like rah rah rah, everything's great, and we're throwing all this product out. That I think it all has to be properly vetted. Make sure that because I hope I'm wrong, but I don't want to see the headlines about some product, mom and pop losing all this money in this product because it wasn't well understood, or there was some swap, something that they didn't quite get. So.
And I think on that front, maybe talking my book a little bit, but I do feel like the SEC's done a great job balancing innovation. Maybe almost a pendulum swung where there's so much, almost too much innovation, but that's not a horrible place to be, because when I first got into ETFs, it was just right around when the first active ETFs were getting approved, and there was a complete, sort of prohibition around derivatives, and it was definitely the other side of that pendulum. So we're closer to where I think is a good balance, but we're starting to see people push the envelope on these type of products. I do think overall, again, the 40 Act structure for the most part, right? The SEC regulation for the most part, it does a lot to protect. It forces a lot of discipline, leverage limits, forces disclosure, which is often where a lot of these problems start, is when people start stretching beyond their mandates or guidelines or taking shortcuts to get things that wasn't necessary before. And I think that ETF disclosure, market makers watching that portfolio every single day, if you don't think someone's going to notice when you do something a little beyond what you're allowed to do, they'll notice immediately. And I think that sort of regulatory part from both the marketplace and the self-regulation to the ecosystem is a big part. And ultimately, we're all measured on our brand. So if you screw up an ETF and somebody's experience, you're going to taint the rest of your brand and hopefully not the rest of the industry. But that's part of the challenge of building a new brand, is you want to balance innovation, yet keep your risks and sort of your long-term brand building in check as well. So,
can I ask you a question?
Sure.
Because you mentioned the ETF rule 6011, which radically lowered some of the barriers to entry, which coincided pretty much with you guys coming to market. Would you guys be in business without the ETF rule?
It'd be much harder, or the employees would own a smaller share of the ETF. Let's put it that way, because it was just basically a legal cost, right? And it was millions of dollars just to start a trust, and that went away. But really, the reason we're in business is the other rule, which is the derivatives rule, and that rule took a decades-long approach to capping the use of leverage inside of a 40 Act, and it basically changed that from what's called the seg assets rule to something much more modernized, more like a hedge fund and a VAR-based regime. And that opened up what you're seeing today, good and bad. But it's really leveled the playing field. It's democratized access. And we're trying to grab that opportunity as quickly as we can. And because we're relatively on the front edge of that innovation, we're able to interact with, leaders in the hedge fund space and the alternative space that we would not be able to do had a couple of other incumbents gotten there first.
I just want to add, so 100% agree, and Simplify definitely is on the front end of that curve, and it's really just beginning. And the whole concept of all these rule changes really have allowed more actively managed ETFs to proliferate. And the challenge is, within that ecosystem, is working together, right? As opposed to kind of, last minute, I'm an issuer, I want to do, I'm all for innovation and getting new strategies out into ETFs. But to kind of at the very end of the process, which happens all the time, we get the call like, hey, we've been doing this for 1.5 years, and now we want to launch next month, and we need an LMM. At that point, lots of decisions have been made. There's not going to be a lot of change, but for us, when I say us, I'm talking a market maker, not just Wolverine, to do an effective job for an actively managed ETF, to make a tight market, to create and redeem, to be comfortable taking that risk, we need to really understand that strategy. And we need to really have a good relationship with the issuer, have a good dialogue with the trader. We can't be told anything different than being told publicly to everyone else. But if we have just an understanding of what the thought process is of what they're doing, it gives us a lot more comfort to take that risk, like we were talking about before, and how to structure that proxy basket. Because there's many different ways to hedge an ETF that owns assets other than just straight up equities. Like for instance, that own bonds that can't be traded, or options that are too expensive to trade in and out of. There's many different ways to do that, and I think understanding the strategies is really key. And therefore, so I'm a big proponent of the relationships within the ecosystem between the capital markets group and the issuer and the strategists, and it's going to just get more and more like that as these ETFs continue to proliferate.
And it's important, the really sort of the end user, right, is typically an RIA, an advisor, somebody who professionally manages a portfolio. And I think ETFs have empowered everyone from the smallest advisor to the largest endowments, right? And when you think of it that way, think of trying to, in the past, buy a bond, right? If you and I, no matter how sophisticated we are, went to go try to buy a municipal bond or a high yield bond or whatever, unless you have the existing relationships and connectivity, you are not going to get a great price, right? And then forget trying to buy 100 bonds or 1,000 bonds. And so what the ETF vehicle has allowed, much more, I think, than the mutual fund, is that you now have a direct drive into the execution desks of either large market makers or large issuers like the PIMCOs and the BlackRocks of the world. And so everyone from the smallest advisor to the largest has now the level playing field where execution costs aren't like the big impediment or a big edge anymore, right? It's really truly build a great portfolio, get the exposures right, risk manage in your own way, and make sure you understand what's driving the portfolio. It's great to see that leveling. And so I think you're going to see more and more of that in all asset classes, right? We're seeing it in fixed income again. And hopefully we get to be part of that sort of conversation on the alts and sort of like those type of strategies that really structured products. There's so much inefficiency built into those products that it would serve everyone to sort of compress those transaction costs down, make it easier to access, and actually spread the volume out so you actually get more adoption, use, and scale. And I think that's really the disruption that the ETF vehicle is driving in that side. And it's been fun, again, being on the side of the provider watching it.
I feel like we need to, not to put cold water on that, I do think we have to acknowledge that we're 3,000 ETFs now. As you point out, a third of these things only launched in the last 2 years. We're probably headed for a world where we have 1,500 at least single stock ETFs. I don't see that.
I hope not.
I mean, just take the S&P 500 and do 3 versions, 2 providers, and it's going to be just an enormous sort of bath of product that's out there. some of it's going to be incredibly narrow, right? So we've seen that in the fixed income space with like bond blocks and FM investments, where they're taking like treasuries and saying, well, why in the world would I spend, whatever it is, 20 basis points or whatever, to get access to the 2-year when I can just go get that on Treasury Direct? And the answer, I was very skeptical until I talked to dozens of advisors who were like, oh no, buying treasuries is a nightmare.
Yeah.
Like it costs me much more than the expense ratio to do this at Schwab, TD, Pershing, Fidelity, whoever their custodian is. There's all of these little weird inefficiencies in the market that you don't realize are going to get flushed out until you find somebody who's actually experiencing the pain. But at the same time, my mom is invested in ETFs, and now the 20 years ago that wasn't such a big deal. There were only a couple hundred of them. Now, she has to choose between, well, do I want to be in the S&P 500 or in leveraged Tesla? And they're right there on the menu, right next to each other.
Sort of even think about where maybe the next leg is, and it was actually the panel before us, like crypto, right? So about what ETFs have done in fixed income trading. I'm not a crypto guy by any means, but it's sort of interesting that, let's say if Spot does eventually get approved, what does that do to the whole trading ecosystem, Coinbase and all those companies too? So ETF is really a disruptor in almost every type of trading. So it's almost, that sort of reminds me what, I'm sure they said the same thing when like LQD was first being launched. Like how is this going to work, right? And now look at it, or HYG trades how much a day. So I feel like there's some areas now that the ETF is starting to penetrate, and crypto being one of them.
Yeah, and there are a lot of advantages to an ETF holding crypto or crypto futures. You have the 40 Act protection. You have the, again, the regulatory body that protects against some of the big headline risks, right? Hacking, custodians failing, counterparty risk. A lot of these things are taken out if you go into the current lineup of futures-based strategies. So you could get a lot of the investment exposure and mitigate some of the risks, but there are trade-offs to both, right? So the ETF solves a lot of problems, and the best ones solve big problems. But even a small problem that impacts enough people is an attractive value proposition. It's really capitalism at its core, right? You sort of take a bet. You're willing to put up whatever the startup costs are, the annual operating expenses, 100 to 200,000 easily. You need to go convince some investors. You need to go build a website. You need to convince a market maker. You need to find seed capital. So there are plenty of hurdles to prevent really dumb ideas from going into market, but they're allowed to go launch it. We got plenty. But somebody's writing that check. And so I think that's ultimately the check on all this, literally, right, is if you're going to take that bet and it's a lousy bet, okay, well, that's money you used to have. That's gone.
Yeah, I hear you. That seems a little Pollyanna to me. I think we have plenty of dumb ideas, both in filing and in the market. And honestly, the costs are only going to keep coming down, right? So your 100,000 is going to, it's only going to get, it's not going to 200 again, right? If you're running a straight beta product. I mean, there are enough folks out there doing umbrella products that, if you've got your one dumb idea and it's U.S. equity focused, it's pretty cheap and easy to get that thing out there in the field, and then you confuse investors with it.
We get propositioned with dumb ideas like every day, by the way.
I got a
so
bunch
there's a filter.
Want some of mine?
Everyone thinks like, oh, I have the best idea ever, and you listen to it, you're like,
Are you alluding to the inverse Kramer ETF? Is that
No, that's so dumb it might be smart.
Yeah,
like those are one of those,
it's like that meme,
He's got
right?
signal, whether you appreciate it or not. There's signal there, right. So. How about any questions from the audience, or we have any apps?
Paul, I just want to add one thing about something that we've noticed on the liquidity side within ETFs. It's really amazing how tight these ETFs are trading to NAV. The competition among market makers, again, through these RFQ platforms like Bloomberg, for instance, which we do a lot of business on, or we just talked to TD recently, like basically taking flow from them, which is coming all from the IRAs at the end of the day. They're noticing and they're commenting on, very often they're doing large blocks inside the bid offer. And they're wondering, why? How is that possible? Why are you guys all falling over each other to win this business at, for instance, a trade with no edge? And the answer really is, if you look at all the market makers who are all out there, providing liquidity, our biggest cost is our cost of carry. So we're holding on to the ETF and we have the basket against it, and we want to create a redeem out of that as quickly as we can, because otherwise, as we carry that position overnight, especially with this interest rate environment, is just getting more and more costly. So if we do a trade that captures some edge on the screen, for instance, on NYSE or BATS or wherever, I'm not allowed to say that word in this room, I think. We want to get out of that quickly. We will be leaning out at, for instance, a NAV offer for a large block of that. So what we're finding is a lot of the IRAs out there are commenting that they're getting these ETFs traded at very attractive prices. Basically, people exiting their positions among the market-making group. So Wolverine might not be a 1 cent wide market, but we may be on the bid because we want to establish a market, and on the offer that's 3 cents higher. But someone else who's long it wants to get out, and they're on the offer or on the NAV offer. So between the market makers, you can see these ETFs trading very tight. And I think that is that's been kind of the theme for the year. And it's even in this high vol environment, it's amazing the liquidity among a lot of the ETFs right now.
Well, and it's amazing how low vol the environment is for how high vol the environment is, if that makes any sense.
Yes, and it, there's the competition out there and the technology that has been created by the market makers has really made this extremely efficient. And you can comment on the amount of business going through like Bloomberg RFQ right now is enormous.
Yeah, I mean, with trading, obviously I'm not part of that team, but anyone with a terminal can run stats on it. It's been good, yeah. A lot of, especially again in a lot of the global markets where RFQ is a much bigger platform for trading. But yeah, it's benefited them for sure.
Or TradeWeb. I mean, there's a lot of platforms out there. But yeah.
The interesting part of that, as trading costs have come down, expense ratios historically have gone essentially to zero, right? But in the last year or two, probably with thematics and other things actively managed or alternative strategies, I think a lot of the pricing pressure on the provider side has dissipated, where we're not getting pushback on some of our strategies, and they would have been eye-opening. Like 95 basis points for some ETFs or more, and there's very little pushback on cost because if you provide something really, really interesting or high-performing or novel, it feels like the pricing power is not pegged to the existing ETFs, but it's really pegged to something like a 2 and 20 or some other approach. What are you seeing in that?
It's a wild market right now in terms of pricing. One of the cool things at VettaFi is we can track advisors' research across different types of funds and different categories of funds. And what we find is like the majority of the research is actually on the most expensive products. So stuff over 75 basis points just gets tons of traffic. People want to learn about those types of products. Now the flows still 80-20 go towards cheap beta, and I don't think that's going to change anytime soon. But when we actually poll advisors and ask them about this, we seem to be in a really interesting barbell environment where anything sort of sub 20 basis points, nobody even talks about, nobody cares. Anything over like 60, maybe 65 basis points, something like that, they also don't seem to care. In other words, it's already so expensive that the difference between 65 bips and 95 bips, nobody cares. They want to understand the story, the strategy, why they're paying up for this. Either it's narrative to talk to their clients about, it's a pattern of returns they can't get somewhere else, it's a hope for alpha that they're really buying into. Those are the reasons. And then there's sort of this big gray area in the middle where a lot of smart beta plays. And people get into big arguments about that. Why am I paying 35 basis points for this when my competitor's at 29? And it's sort of bizarre because there's this middle market where all the arguments happen, and the tails nobody seems to care anymore.
Yeah, no, that's a good point because we'll track like average expense ratio every year, and I think for the first time, like 21, like the average expense ratio went up. There was always this interesting survey I saw from BBH, which I guess they're State Street now. It was asking what was the most important criteria to ETF users. And as you can imagine, it was always expense ratio at the top. And for the first time, that actually dropped down quite a bit. And it's this theory that we look at with like sort of cost saturation. And what I mean by that is when you look at the cheap beta stuff, it seems like everyone's already either low allocated to a Vanguard fund or iShares is matched what they matched. And even there's free ETFs. So Boney launched the free ETF, and they're not even getting traction with that. So it's almost that is cost even the differentiator anymore, right? So almost you have to get moved into that lane where it definitely seems like a little bit, not as cost sensitive because If you want to go to that 0 to 5 basis point bucket, you're fighting with Vanguard, and that's just a tough fight. Maybe eventually, do thematics and active and these strategies do come down as competition ramps up, maybe. But for right now, yeah, there definitely seems it's pretty inelastic there with people wanting to use those products. It's definitely barbelling and splitting up.
So that's even more interesting in the context where BlackRock's out there saying, half of their flows come through models, right? And so if there's these wholesale access points to ETFs, and it represents 50%, maybe more, particularly in the RA channel, why cost wouldn't be a bigger factor. So it's really interesting. But on models itself, that's another entire arms race. So as many ETFs are out there, there's probably more models available, right? And so we have some friends in this room, and fighting for shelf space as a model provider has, a crazy competitive dynamic that goes, I think, beyond ETFs. Do you have any visibility through VettaFi or any?
Yeah, I mean, so one of the great, you mentioned the point is there are probably 15,000 models out there, and there's every version from something that you're paying directly for through InvestNet to stuff that's just being delivered on paper, and you have no idea whether anybody's tracking the signal. I understand the attraction, particularly from the advisor community, for models, because as this market gets more and more complicated, being able to reach out and lean on either the Carson House model or something that I'm licensing from Newfound or wherever it's coming from, it provides me a bit of an out. And it gives me a thing to talk to my clients about that I'm not totally on the hook for myself. And a lot of advisors, particularly what I would call sort of the golf playing asset gathering type of financial advisor, they need something like that, because the days when they're just going to put together 3 or 4 ETFs and call that their average client portfolio, I think are long gone, particularly in this market environment. But it creates a huge problem for ETF issuers, because getting access to those models is much more difficult than getting into an RIA's door, right? Because a lot of times there's incredibly smart people putting those models together, and all they really care about is, are you giving me a beta that fits in this model, and how cheaply and how well can it get executed? Mm-hmm. And to your point, that's a tough market to play in. So unless you've got something that's really going to be model bait in the satellite, I think it's very tough to break into.
Again, so strange comparing that dynamic versus what's getting the flows and pricing power today. How about you, Ethan, on that side? Do you interact at all with the model sort of providers or strategists? How do you see it from a market-making community, seeing the stakeholders evolve?
Yeah, I mean, we don't directly interact with the modelers, but we see the results, right? So we see the flows. When they come in, it's very obvious when a certain name is being sold and another one's being bought, and we kind of very quickly realize, okay, there was some signal was just crossed or some model was just delivered. So it's more just from the flows that come in.
So do you adjust your pricing based on the source of that volume? Like if you go, oh, this is an ad to a model, it probably doesn't have an edge behind it or something where
No, but it is clear, like the first group that comes in to kind of execute that will get the best pricing.
I was going to ask, how do you, because this is a real problem, right? There are a lot of models out there that some are being implemented directly through a platform, some are being implemented on paper, some are being implemented through, Ray J's desk or whatever it is. Right. But they're all, selling TLT and buying SPY or whatever the move is. Right,
but from what we understand is when that signal is given, there are people who pay up to get that early, and the people who get it at the end, obviously the prices will have moved by that time. So from what I understand, I don't know, there's a hierarchy.
There are tiers.
There's tiers of who gets that signal. Wow. And whoever gets that first is obviously going to get when that volume starts coming in, they're pushing the market. It's just.
And it's pretty well understood in the trading community when you see those kinds of moves. It's like, oh well, that was the 10:45 trade. We can expect another 2 hours of that.
Absolutely.
Yeah.
And at that point, market makers like us just kind of know that flow's coming, and
position.
As I said, it's you can't expect, if someone just keeps on buying something, that the price is just going to stay there. It's just the nature of the market. So, and then obviously the hedging we're doing against it is pushing that down. So the dynamics are just going to push that spread wider as it comes.
So knowing all of these things and knowing sort of there are parts of the day where markets are very thin. What are some good rules of thumb for providers, not providers, RIAs and advisors who are looking to enter or get out of a trade? What are some good trading tips?
You want to start?
Yeah, I mean, it again depends on the size of the trade. I'm a big fan of VWAPing things throughout the day. Again, if it's if I knew that it was some model signal and that the world's getting it, and there's a lot of people who follow that model, I probably would just do that trade as early as I can and not VWAP it. But for any other, if it's your own research that's causing you to do that trade, rather if it's a large block, as I said, it's kind of amazing that the pricing that large blocks has been getting recently. But in general, if you're, there's a lot of movement during the day. You have no idea whether the end of the day is going to be, 100 basis points higher or lower than where it is at the beginning of the day. So I've just found that unless you have an opinion, a VWAP seems to, at least what I've seen, gets the best results.
I probably won't have too much to add to that besides sort of like the usual, know what you own and whatnot. But, they got rid of the INAVs, right, with the SEC rule. But, in some areas, it could still be pretty useful, just maybe as a gauge. But with some of the products coming out, it's tough to get an INAV, right, on some of these with options and whatnot. So obviously know what's going into it. And also, whoever you trade with, they have cap markets desks you can reach out to, right? And they're always happy to take your calls. So always feel free, if you don't understand, if you're trying to make a big trade or whatnot, feel free to reach out to the desks. They're always really helpful and walk you through the trade.
Yeah, that's a great point. If it's a simplified product that you want to do a large block in, no one knows that product better than the simplified cap markets team. And
right.
To get their advice of, hey, what do you, I want to put 100,000 shares to work or $1 million to work. What do you recommend? It's a great way to go. The other point you brought up, which is key, is a lot of people look at the INAV intraday, whether it's disseminated through Bloomberg or anywhere. And there's lots of different companies I know that provide that. It's not always accurate. And we get a ton of calls on our desk of like, hey, I just executed this trade and why did I pay X amount of cents over, or why did I sell it under INAV? And there's always an answer to that, and it's usually that the INAV is off, and we can painstakingly go through the basket and show where, why we think, actually, we tell them actually, you got a penny over NAV. You got a great price. Be aware of that. That it's not always accurate, especially if the basket is holding options or other hard-to-price assets.
Yeah, at this point, I tell people to basically ignore premiums and discounts, because as an individual or as an individual RIA trading a portfolio, you just don't actually have the time and money and energy to put into creating your own fair value model for any ETF. Sure, S&P 500, like some things that have big, obvious,
Sure.
Instantaneously trading benchmarks, sure, you can do a little bit of math on that. Once you're into anything more interesting than that, other asset classes, whether you're using derivatives, a unique indexed exposure, whatever it is, you may think you can roll up a version of that in Excel that's going to give you a real-time indication. You're wrong. The guys on his desk, are sitting there for hours every morning making sure that their pricing models are perfect, and you're going to be wrong. And so at this point, I would just ignore that unless you're focused on something that's really niche and really illiquid, at which point you sort of have to be asking, is that something you should be putting your clients in anyway?
Yep. Let's see, from my perspective, any questions for a provider's perspective? Ask away.
Well, I'd love to get just between the two of you. We've been hearing about the seed capital wars for years, and for a long time it was you needed 5, you needed 10 million. Guys like Wolverine were the ones kicking in that money.
Yeah.
We saw a fund launch today with like a $500,000 seed.
Yeah.
Like that seems to have changed a lot.
Yep.
With the cost of capital rising, how do you think about seeding new funds?
So part of that is some of the rules around listing change, right? With the ETF rule, your basket sizes have changed. So there are limits to what you could have done before. And then also related to that, or maybe not related, the stigma of launching a small fund has gone away. Whether it's $1 million fund, $5 million fund, it's too small for most big allocators, right? And if you have a really interesting product, that million should turn into 5 or 10 in short order. That's sort of been our philosophy, is just get something live, get the track record going, and demonstrate performance in the market. And it's worked out, but I think the need to come out with a $100 million ETF, I don't think it's really there anymore, because it doesn't really provide you a real shortcut, right? If you don't
Gets you
have
some PR.
it gets barely, right? Barely. Is someone going to write? If a $1 trillion asset manager drops $100 million into ETF, do you write about it?
Yeah,
Not really.
sometimes.
Right? Maybe if it's a slow.
If it's a small, but if it's a smaller issuer and they come to market with,
that's
this firm has 10 funds
They'll
and they
do
have a
some
$100
story.
million fund, usually there's a story behind it, a
Yep.
big pension fund, a big institutional client.
So I think about an ETF success not as the initial AUM. I think of it as how much volume can you get, because volume tells you that it's going to have organic flow eventually, and that's what I look for. A small ETF that trades a lot, to me, is a better success outcome than a large AUM number that has 500.
Even though you get paid on AUM.
Yes, yeah, ultimately, because again, if you have the mindset that that's not the end game, and the end game is to have a blockbuster ETF or something that's used by a lot of investors, you care that you have success at the actual organic level, right? So you can't fake your way past organic volumes. And it's healthier to measure success against that, because again, it's giving you a real signal, not that you successfully convinced a committee somewhere to drop in, corporate money. That's fine and all, but that's not going to really help you turn that into a blockbuster. You either have a really good story and a great strategy and an edge to delivering that result, or you don't. And I'd rather know that sooner, because I'm not interested in running a big ETF, small ETFs that suck out capital. I'd rather use that shelf space for something much more interesting. Any questions? I see a little finger there. Jim? Someone have a microphone for him, or Bobby's coming around?
Dave, you talked about that you don't see ETFs going away in your career. A couple of years ago, there was a big splash made by portfolio construction, through M1 Finance, and just being able to circumvent the whole ETF thing and just buy the stocks directly. Now, this won't work for alternatives or for fixed income yet, but do you see that as being something that could, at least in the equity space, especially beta, to maybe make a run at the ETF stronghold that they have?
Yeah, so direct indexing has already had a bit of a run. We went from nobody believing it was a thing 10 years ago to now literally every single provider of direct indexing services has been bought by somebody, right? So we went through the entire sort of entrepreneurial growth and acquisition phase in about a 10-year cycle. I don't think it's the kind of thing where every individual is going to have a direct indexing account and have their pro rata share of 500 stocks and 200 bonds. But in the RIA community, particularly around large single position management, it's really caught on. The folks like Canvas, which is now my Franklin Templeton, the O'Shaughnessy product, I've talked to a bunch of advisors who have billions of dollars in that platform, almost exclusively managing down large single stock positions for executives who have 30, 40% of their wealth tied up in company stock. Hedging out that industry exposure, not double investing in those companies if they're already large in the S&P 500. Those are real use cases that direct indexing solves. For the average investor, yeah, maybe you get some single stock tax loss harvesting in the mix. But there's a limit to how much of that you can actually do in a portfolio, and then you're stuck with a portfolio that's got theoretically difficult unwinds if you decide to move that money around. So I don't think it's a panacea. I think longer term tokenization, which we talked about earlier on stage here, I think that's actually where things head, is towards just tokenized beta. But we've got a bunch of regulatory hurdles before we even start to play in that sandbox.
All right, well, we've hit our time limit. I want to thank our panelists. Thank you for your time and your expertise, and it was a very, very fun conversation on ETFs.
Thanks for having us.
Thank you.
Thank you.